Investors are mulling over the federal budget this morning, along with a slew of earnings results and, of course, the questions about AI valuations. Let's get perspective now from Martin Cobb, Senior Vice President at Lorne Steinberg Wealth Management. Martin, thanks very much for joining us.
Good morning, Roger.
Did you like what you saw in the budget?
It was sensible, I would say. I didn't spend too much time looking at the document. I guess there was no baseball last night, so I could have spent time reading the 500 pages. But I kind of like what they've done. I mean, it's reasonably sensible, kind of locked their, handcuffed themselves in terms of the operating budget down the line. But it's still more spending. Whether you call it, operating expenditure or capital expenditure, we, the taxpayers, are still having to fund that. But I thought it was reasonably sensible. Ultimately, though, will you see, you can lead the horse to water, but can you make it drink? Will you see corporations follow up on the incentives that have been offered them and invest? That is the bigger question mark.
And will this have any impact on the markets? Are they going to react to this at all, this budget?
I would say no. I mean, long term, I'm not a huge fan of big government. State-directed, industrial policy was very successful post the Second World War. Been very successful in some of the tiger economies in Asia in the 80s and 90s. It's got a less good track record, shall we say, in terms of governments making decisions on where industry should be investing. And I don't think this really changes all that much. They tend to fight, last year's war in terms of directing investment into areas that are hot today. So we're playing a bit of catch up. Ultimately, smaller government, more incentives for productivity is all well and good. And I do, commend them for that. But ultimately, will it flow through to economic growth and impacts on the stock market? I'm more circumspect.
Okay, let's talk earnings. We are in the middle of the season right now. Seems like for the most part, a lot of the reports have been good, U.S. tech companies especially, but investors still not sure what to do with it all.
Yeah, I spend less attention looking at earnings season than most. I mean, we're looking at 13 weeks of results, and then you have the crystal ball gazing of management, which we read between the lines and hang our hats on as investors. And if you look at the same information as everyone else, you'll come to the same conclusions. That being said, I do like to, Mr. Market comes along and can create some opportunities. There really is a bifurcation at the moment between those, who are loved, in the have camp and those who are unloved in the have not camp. And you've seen stocks like Meta, last week kind of moving from one to the other as investors didn't like what they see. So I don't pour over too much information in terms of what's happening in earnings season. I try not to focus on the noise. But ultimately, the long term is made up of the short term. And businesses will continue to invest accordingly, and investors, appropriately will make their own decisions.
So where do you look then during this season?
Anywhere but earnings season. I tend to look, I spend my time, I spent many years at Franklin Templeton and, learn a lot about Sir John Templeton and his focus, which is not dissimilar to the Warren Buffetts of this world or the Charlie Mungers. Long-term investing, getting away from the noise. He didn't have an office in New York or London. And so, where are the opportunities being presented to us? And I tend to find that investors just ignore stocks or ignore sectors, and the apathy can persist for quite some time. And that can create some great opportunities. I'm going around to my neighbors for dinner tonight. They're not going to ask me about some dull, boring stocks. They're going to ask me about AI, the level of the market. What do you think of NVIDIA? I think opportunities tend to lie elsewhere.
And that's one of the questions, I guess, is AI. Are we in a bubble with that? We hear frothy, but are we in a bubble with it? And can you see people pulling out and looking for those other areas now?
I was first given my first funds to manage in the late 1990s in the technology and media and telecoms bubble, and I looked fantastic as an investor for a couple of years, learned nothing, and then 2000, 2001, 2002 came along. And I realized I wasn't quite as good as I thought. Here we are today, and there's definite similarities between now and then. And you can really argue it both ways. I've seen, compelling arguments based on the PE of NVIDIA being quite low. Well, NVIDIA's net income today is 20 times the revenues it was several years ago. So are those profits sustainable? But that's a real business. But what you're really seeing is some of the private valuations. There's something like 500 unicorns in the AI space with nothing much more than maybe an idea. And that to me is their speculative frenzy. So Howard Marks, who I think is one of the best commentators on market cycles, He recently was saying, yes, there are signs of excess, but we haven't quite seen that real psychological kind of frothiness that you would say is typical with the peak of a bubble.
Okay, we're almost out of time. I want to get to some of your picks here. CNR, Canadian National Railway.
Yeah, a real business. It's AI, no idea. It might help them move some cargoes around, but ultimately it doesn't really matter. It's been around for over 100 years, will be around for another 100 years. The railway stocks, and we own both up here in Canada, they get hit from time to time with lots of things, whether it's political interference, bad harvests, wildfires, and here we have trade and tariffs. But ultimately, they grow through thick and thin. The business today is trading on about 17 times earnings, historically commanded more like a mid-20s multiple. It'll still be around in 100 years' time, shipping cargoes, still got that great duopoly. Barriers to entry are formidable. Long-term grower. We like them both. This one's a little bit cheaper, a little bit less growth than CP Kansas City, but ultimately we like them both just because they're real businesses that no one talks about.
Okay.
Apart from me.
And Starbucks is the other one. They just announced that sale in China, 60% of ownership going to a Chinese company. Your thoughts on Starbucks? What do you like about it?
Yeah, they're obviously extricating themselves to some extent from China. China has been a really tough market for them. There was some disappointment on the price that they achieved for the 60% stake. I think Starbucks just looks really interesting. Brian Nichol came in, you saw a massive one-day pop, the 20% plus move in the share price. And that is excess is just burnt off over the last 12 months or so as reality has set in. But here we have, the US business, which is all important, stabilizing. Long-term view on Starbucks is they're not going to go anywhere. They ultimately will be around. They do need to get the customer-facing proposition sorted. But ultimately, if they can get back to the typical operating margins, 15%, that's $5 plus of EPS, earnings per share, and that's a cheap stock you'll have in your hands.
Okay, we'll leave it there. Martin, thanks for joining us.
Thanks, Roger.
Martin Cobb is Senior Vice President at Lorne Steinberg Wealth Management.